All right, there's been a lot of wonderful questions, so please keep those coming. We're in no rush, no hurry. I think we're a little behind schedule, but I'm not gonna like try to overly compensate for it. So I think that the interaction and the questions are actually where a lot of the value come when you think about your own business, what you're building, and you're able to learn from others in the room as well. So now moving on to competitive advantage. This is the point where you start to talk about why do you win? Why are you going to win against your competitors? Why are you going to win in the space that you're at? Not to put you in a box, but there's kind of some best practices. Typically, you would win in one of these 5 categories: your product, cost, positioning, distribution, and execution. I always, and I think not even my own wisdom, everyone's kind of wisdom out in the ethers, are pick 1 or 2. If you say you're going to win in all 5 of these, it's just not realistic, and you then don't really have an advantage. It's kind of watered down amongst 5 categories versus saying, I'm going to be the best at this and this. And by being the best at these 2 things, I'm going to be the winner. So some examples of how you might talk about your competitive advantage in each of these areas. Under product, it might be your ease of use. It might be your IP. It might be that you create some unique barrier from someone switching from your company to another company. Distribution, this might be the way that you're disrupting the buying chain, how people come to you versus your competitor. Cost, I think I've already shared a little bit of my opinion on cost. It's not always the place that you want to win, but sometimes you're very disruptive to the ecosystem, and you can just drive a cost down like no other. You think about Walmart. Walmart is all about cost, and they've really made that their competitive advantage as being the lowest cost. Execution. Are you the first mover? Are you a uniquely qualified team? I think this one can get you in a little bit of trouble. If you are the first mover, but maybe a large company can come and do the next thing right after you, and they're more well-funded, it doesn't really matter that you're the first mover. I'm sure you've often seen this. Some of the first movers aren't the company that's actually successful. So be careful if you say, I have the first mover advantage. Really think through what that means long-term, and if it is actually a long-term advantage. And then positioning. You might have a very unique brand, a very clear value proposition that as a company puts you in a unique spot. I'm going to give you a few minutes to work on what is your competitive advantage, and I'll be taking questions as you guys are working on that.
Would you mind elaborating a little more if you have an example or something on positioning?
Yes. Good, bad, or otherwise, one of the companies that comes to mind first is Zappos. So lots of people sell shoes, but the way that they put together their branding around customer support and who they are as a company really kind of makes them stick out from any other shoe company, as one example. Does anyone else have a brand example? Mike, do you have another brand example? The one I said was Zappos that was very uniquely positioned, of lots of people selling shoes, but Zappos did it in a positioning way really unique. What's another example you may have?
I would use Tesla right now. There's a lot of electric cars out there, a lot of good ones. And Tesla, for all the challenges and the craziness of their CEO, people are lining up still to buy their car.
I think early on using brand is somewhat challenging because the reality is most people haven't heard of your brand.
They don't have a brand.
So either you better have a very good strategy around why you're going to be so unique from a brand, or it's probably not the best way to position yourself early on as the competitive advantage. Any other questions on building out your competitive advantage? Go to market / the marketing plan. This is where you start to talk about how either you have or you plan to bring your product to market. How do you plan on selling it? What channels are you going to be focused on? Are you selling direct? Are you selling via channel partners? You think you're going to build it out organically? Are you building very specific high-value partnerships that are going to help distribute your product? And then what initial validation do you have that your plan will work? And early on, your long-term plan versus your immediate plan might be different. And an example of that is long-term, you might plan on having channel partners. But initially, maybe the first 2 years, you need to sell direct in order to build credibility, in order to test your product, in order to get it out there. And so just depending on how much clarity you have on vision would be the level of detail that you'd go in here. Sometimes I see people say, the next 18 months, this is what we're gonna execute on. Be prepared to talk beyond 18 months, but I think it's just fine to say this is what we plan on doing the next 18 months. I think if you have channel partnerships in there super early and you haven't yet proven out even the product in the market, you might get some questions and some pushback from investors. They might also say, do you want to put that much in kind of invested in channel partners that you can't move the needle as fast as selling direct? So that's kind of the shift, like phase 1, phase 2, phase 3. How do you think you're going to sell your product over the next several years? And then if you have any traction, if you have anything that shows, hey, I've demonstrated that I can sell direct, show kind of what that traction looks like. If you have been able to establish some distribution partnerships, start to list what those distribution partnerships are as kind of proof points of this theory. I've been able to prove out that in some sense, I've gotten early traction around it.
I have a question on some of that. So if you've talked to audience, whatever it is you're trying to sell to, and you've gotten some great validation, some great feedback, but it's inconsistent, meaning I don't have like a set of standardized questions. Is it awkward to go back and say, I know we already talked about all this stuff, but what is your favorite color? Right? All this kind of crap. But then when it gets to time, now I've got quantifiable data that I can say, of the 20 people that I've talked to, 9 are doing this, 3 are doing that, 5, and it's not just so much a note-taking session on my part that.
Again, it's somewhat hard to respond abstractly, but I'll attempt. I think there's a difference between interest and actual sales. And so an investor will probably push you on that of, that's great, you did a survey or you've talked to 20 people and they're all interested, show me the money. Right. At some point, can you show pilots, like that they're using the product for free? That free is not always awesome, right? But are you able to show someone using your product? Usage, dollars are usually what they're looking for, like, hey, there's initial proof point. Or if you're trying to say, all of my customers are gonna come organically via online marketing. Well, you better have been able to show, I spent a little bit on Google AdWords or this or that, and this is the organic traffic that I was able to attract. Versus saying, yeah, I'm gonna do this all organically, but you have nothing to show that people will actually search you out and find you organically.
Thank you.
Okay. Any other questions when it comes to your go-to-market / marketing plan? It doesn't have to be super detailed either. If someone's going to invest in you, they're going to go deep on, okay, talk to me more about your marketing plan. Are you going to trade shows? Are you doing this? What's your budget? How much do you plan on spending on online advertising? That will come later. This is more just high level. How do you plan on attracting customers? Team. Highlight any special talents or experience that make your team well suited to do what you're doing. This might be your key founding team, or if you, I would say super early on, you probably don't have like a whole VP team, and if you inflate people's titles, please don't do that. It looks really goofy if you have someone who's a coder who you call your CTO, but he has no CTO experience. I mean, think about those titles. I think early on you want to slap like all these titles on, but you should be able to defend, yes, they are CTO, they do have strategy and vision beyond just execution, if you call them your CTO. It's okay to have some holes in your team. Everyone knows that you're early on and this is not the team that you're gonna have in 12 months, 18 months. That's kind of why you're raising capital, is usually a lot of it goes into investing in your team. But hopefully that early team shows that you're, qualified to take this to the next level, qualified to figure out how to build out that team, to take the capital you're raising and move the company to the next milestone. This would also be if you have a board of advisors, you can either put them on this slide or do 2 slides on your team. Question?
As far as the CEO, COO, CTO whole piece, we initially stayed away from that just because we want to be, realistic as to who's on our team. We have good people, but maybe they don't fill that role. And then we had, as we were talking to some of the VCs, they were asking us, well, who's your COO? Who's this? We said, well, this person handles the operations, but they're not the CEO, and that caused them to then kind of question more why they weren't that person. What's a good way to kind of deal with that, where we want to be understanding that we would like to hire a professional at that, and we have someone who's filling in at that role now, but not that we're just unprepared for it or we're just kind of throwing people anywhere.
I think it's how you talk about it, right? And you tell the story. And some investors might be pushing you just to see if you have clarity around it. Is it no one has clear roles and responsibilities and no one wants to have titles because there's not clear separation of who's actually responsible for things? Is it, hey, I have a great team who I think is going to take me to the next 18 months, but I don't think that person's going to be the COO long term. Therefore, it would be ridiculous to call them the COO right now. Like they might be a VP of operations because long term you plan on hiring a professional COO. Or you might only need a controller, but not a CFO right now. So it's again how you have the vision. It's like, what are your intentions? And they might not be pushing you because they expect one thing or the other. They're diving deeper on what's your vision around your team. Does that match kind of your experience?
Yeah.
Other questions about team? Trevor?
One of our big gaps on our team is like the actual sales side, sales and marketing. But we've been kind of hiring for the role, so interviewing for it. And we have a person that we think is going to be the person, but we've known this person for a while. We've had a lot of discussions with them, and we both think it's better to bring them on after we finish raising the money needed, because we wouldn't be able to afford them otherwise.
Right.
So they said they're comfortable with us talking about them, and they're willing to talk to investors and say yes, they're going to take this role. But do you think it's you might want to stay away from that?
Yeah, I would leave them off the slide until they're full-time, because a lot can change. Even if they're super committed, they might not, if it's 2 months, 6 months, 12 months before you get the fundraise done, their life might change as well. So there's kind of a danger of putting someone on there that's not on the team. I think it also overrepresents where you're at. They're not actually on the team. But I think it's okay to say, once we close this round, our intention is to bring this person on. We have someone identified, they're really excited. I think that it's okay, because it shows the vision for a gap you have and how you plan to fill it. But that plan might change, because everything changes in time.
Okay, thanks.
Other questions around team? Jen?
So for advisory board, is there a formula who you think is best to put on your advisory board?
I don't think there's an exact formula. I think it should fill gaps that you have. And sometimes, through my own experience, some of the advisors we had were positions we weren't yet in a position to need full-time. We didn't need a CFO super early on, but they were on our board or an advisory board, because we knew we wanted some of the expertise, but it didn't make sense in a full-time role. You might think about, what are the gaps that you have? Is it in HR? Is it in selling? Is it in real estate? Whatever gaps you might have, and is it realistic that an advisor can add value? You kind of lead into my next question, or my next slide. Advisory boards aren't expected, but sometimes can be very helpful early on. Some things to keep in mind: if you have an advisory board, you really need to be keeping them up to date. And utilizing them, and not just putting their pictures and names on a slide, because most savvy investors will call your advisory board and say, hey, I want to get your thoughts on this, this, and this. And if your advisory board isn't really clued in, that's not actually adding a lot of benefit for them to be part of your team. Also kind of managing the time, and how much time are you spending getting your advisory board up to speed versus what are they able to contribute. I've seen some people build out these elaborate advisory boards, but then they don't actually really utilize them, but they put a lot of time into meeting with advisors and getting them on the team, but then it just became one more thing for them to manage unsuccessfully. be clear on what you want from them when you're meeting with advisors. Is it like a weekly call? Is it a monthly check-in? Is it they're going to be part of a kind of a board meeting? Those all things help you be more successful. And don't overplay in your pitch. An investor knows like an advisor is not a full-time role. They can, they're often not paid. So the impact to your company shouldn't be overplayed. Other questions around building out your team slides? All right. Now moving on to traction. So highlighting what you've been able to accomplish to date. And as we talked earlier, traction can look like different things at different stages. It might be product traction, it might be customer traction, it might be sales traction, and it might be kind of user traction. Sometimes early on you might not have a lot of revenue traction, but you've been able to show that people are consistently using your platform. If you're able to chart it out, if it's data, charting out traction in a visual way is really helpful. If it's milestones as far as execution, you might build a timeline that shows these are all the things that we've accomplished. That shows kind of execution traction. There's different ways to visualize it. Try to make it interactive than just like some bullet points of these are the things we've done. Question around traction.
So let's say, hypothetically speaking, you're going along and then you change your personnel, or like you said, sometimes you have to change your team, and your growth pattern or your traction pattern takes a major dip. Mm-hmm. How do you counter that? How do you address that? Because I know in business, it's just like you said, raising money is like this, so is business. Business never really follows that clear of a trajectory. At least my experience has not been that. How have you seen that addressed in slide deck? When, especially if you're in an older business, like not a startup, but you're also going to raise capital to take it to the next route.
Makes sense. There's a couple of things. One, I would say it's how you visualize the data. Sometimes an investor doesn't need to know super granular things, right? What might seem like it rocks your world and like a outside viewpoint wasn't a big deal. So if you're showing, it might have affected your monthly data, but if you were to like pull it out, like what did your yearly data look like? What did your quarterly data look like? That's something I've done with my customers where they were so close to it, they felt like, oh my gosh, I have this like big red flag that I'm gonna have to explain. Investors know you have up and downs, and if you pull out one like by quarter, all of a sudden the data looked pretty consistent. But it just felt so emotional for that entrepreneur. So one, think about the data. Like, is it as big a deal as it feels like for you? And if it is, if you have ups and downs, like if you pull out the data, by quarter or by year and it looks like a big down, just be able to explain what happened. Again, investors are used to things. They don't always, it's almost like a red flag if it looks too perfect, right? Like, like everything was just perfect. Most investors know that that's not the case. We have ups and downs. There might be seasonality. That might be another thing. The data might look worse than what it is, and you're able to say, we know seasonality happens here and here. If it's that obvious, you can, actually put that on your traction slide. Explain what the ups and downs are ahead of time. This past week I was looking at someone's deck, and their most recent quarter looked awful. I was like, what happened? And they're like, well, that's only a month and a half of data. And I said, well, you need to better articulate that, because as an investor, my first reaction was, you're having a horrible quarter. But they hadn't finished out February, and they hadn't even started to put March's numbers in there. So just be really careful of how you put the data in there.
Thank you.
Any other questions on traction? Do all of you kind of yes, no, know how you show traction in your business? Or are you still trying to figure out how you would demonstrate that?
I would still be trying to
Kind
figure
of the
that out.
wobble. Generally, yes.
I would still be trying to figure that out yet, but I'm just too early in the process of even.
Do you have customers yet, or is it still in product
It's
phase?
the product phase, yeah.
Product phase.
Doing all the research of, is this even an idea that people are interested in? Yes,
Yeah.
no, yeah, it is, great, cool, I'm gonna start building one for free, try it out, let me know.
I think those are the things, what are the activities you've done to start to prove out, to show that there's less risk to an investor? those are the things that you've accomplished.
Sure.
All right, now to the fundraising slide. This is where you say how much you're raising. What round is it? Is it angel? Is it seed? Is it series A? What do you want to achieve in X amount of time? So if you're raising $2 million, what are the set of milestones that you're hoping to achieve in that next amount of time? And I found like a simple timeline can be used to show, hey, we're bringing this money in and these are the benchmarks that we want to achieve over time. You might be, it kind of goes into, I don't have it in here, sorry. So sometimes together I would see a fundraising slide and then a use of funds slide. And on the use of funds slide, you would say, you know, I want to spend X on marketing, or I want to invest $500K in these key hires, or I want to spend $500K on these product iterations. Usually it falls into some of those categories. What are you going to spend on people? What are you going to spend on product? What are you going to spend on sales and marketing? And this can be very boiled up. Remember, this is kind of the first time they're meeting you. You're not diving deep into the financials, but you should roughly know, people, product, sales, marketing, where you're going to spend the money. There was a couple questions that Bernie asked me kind of over the break is kind of what's your strategy as far as what you put out there as far as what the asks are. And there's a different approach to this. One, does it matter kind of what you're raising? Is it a seed round? Is it a friends and family? Is it an angel? I would say don't get so caught up in the vernacular. If you're not building a successful company, it doesn't really matter. But one word, kind of like a little wisdom that I learned over the years, at Dwella, I think we did this, I would say in my opinion, we did this kind of naively. We raised an angel round, or an A round that was $1 million. Then as we went to raise our B round, which was $5 million, most coastal investors would see $5 million be the A round. And so then when we raised our C round, everyone expected us to be kind of much further, but really it was only our B round. So this is where it does matter of, it's okay to have an angel round or a C round multiple times before you get to that A stage. Just be thoughtful about that, but don't spend too much time, over engineering it. I've seen like complicated A1 round, A2 round, and then that gets confusing as well. But do give it some thought as you're starting on this journey, kind of what those phases look like.
Would you mind explaining to your perspective just briefly about the difference between seed and angel? Like I've seen companies that are revenue generating, raising, announcing a seed round. I think of seed as planting a seed, it hasn't grown. So I don't know. Do you have any? How do people normally? What's the difference between angel and seed? Most people.
I don't know if I can give you a good answer, because for one example, I could say here's a seed round, and then another one they're calling it an angel round. That's where I'm not always sure that the vernacular works. I would pay attention to the investors you're raising from. What language do they use? And that sometimes might set the tone of they do seed round. Like in all the announcements that they invested in, it was seed, seed, seed. Another investor might, they call it an angel round, and everything they've done is like, we invested in this angel round. I think different funds do it differently. If you're pulling together groups, which we'll get into strategy more, I might table this for when we get into the strategy. But there's not a hard and fast rule in my experience. I think another question is, how much are you raising? Have a clear view on how much you're raising, knowing that you might have some upside on there. If you're getting a lot of traction and you would know what to do with more money, you might end up raising more. I think there's also this perception of, are you successful in your fundraising? So if you set out to raise $1 million, but you're only able to get to $750,000, you can, in kind of investors' eyes, look like you failed at raising the full amount. So think through, hey, if I hit $750,000, could I put that money to good use? And do I say I'm raising $750,000 and oversubscribing another $250,000? Do you sense the optics there? Like if investors kind of want to jump on success. So I was successfully able to raise $750,000, because of all the interest, I'm going to raise another $250,000 to get me to $1 million. Versus, man, I really want to raise $1 million and I'm having a tough time getting there. What do you think is going to be more compelling to those investors to say, oh, they're having success? that might influence the amount you state that you're gonna raise. I see a lot of times people setting a minimum and saying that they might oversubscribe to that, but they are very clear on what they know they're gonna do with that minimum amount. Typically, you would raise for 15 to 18 months of runway, and knowing kind of what milestones you would achieve. Early on, Trevor, to your question, like if I only need 100K to get to X, you might raise less and for a smaller amount of time, that first kind of seed round or that friends and family, because you have a lot to prove out with a small amount, versus going and saying, I really need $1.5 million to get 18 months down the road. You might have to show some initial traction with a smaller raise first. And then I would say, raise the amount that allows you to get back to building your business. Sometimes raising more can totally take your focus away from the business because it's just taking so long for you to raise it that your traction starts to go down. So what's kind of that sweet spot for you that allows you to get it done and back to work? This in itself, I think, could be a 2-hour workshop. What's my company worth? So I'm going to give a very, very high level, probably oversimplifying it. I know that going in. The truth that I've seen, this again, my opinion, is the valuations are often determined on how much the investor wants to own of your company. And there's some, pretty standard mathematics behind VC firms, how much that they want to own if they're going to put time and money into your company. This is typically, in the 20 to 25% range. So the math is pretty standard of, okay, so what does that make your company worth? There's different ways around this. Sometimes early on, you're not in a position to really put a logical valuation on your company. That's why sometimes people raise debt rather than equity at the very early, because they don't yet want a valuation on their company, and they don't think they're going to achieve enough in 12 months to make that valuation an exponential growth. Later on in your company's life cycle, there's more sophisticated tools, I think, to set valuation. What is your IP worth? What is your revenue show times a multiple that's normal for your industry? Early on, when you're pre-revenue or just such small revenue, it's virtually impossible to use those kind of more standardized methodologies to determine valuation. Does anyone have questions on this? Mike, you're smiling. I don't know if that's good or bad.
It's hard. Early stage, it's how much, it's value based on what someone will let you raise. As an investor, I'm not going to come in if I'm discrete valuation. So it's negotiation.
This is, I think it also relates back to a question, or Bernie and I were having a conversation of, you don't want to go to investors with completely no idea, but I think you don't want to go in hard and fast on a number either till you've somewhat validated it with investors. Some strategies, if you're able to do a competitive fundraise, you would not set a valuation. You would let the investor set that valuation. They would give you a term sheet that says, I'm willing to invest X at Y dollars. And professionally, they're used to doing that. They see a lot of deals. That is standard for them. In non-coastal markets, sometimes it's very hard to fundraise in that manner, and you need to lead the way as the company by setting the valuation, by setting the amount you're going to raise. Again, I would validate that though with who are some investors that are interested. Say I'm thinking about this valuation. Is that something that's palatable to your organization, to you as an individual? Get some feedback before you kind of overshoot and get lots of no's, because it's hard to go back. People, you might not think that people share information, but if they're investing in you, they're likely talking to other investors. And if you're all over the board, yeah, that guy said his valuation's $5 million. Oh, I met with him last week and he said it's $2 million. I mean, you just want to be careful of those conversations. Sorry, was there a question?
Well, I have a lot of questions around this one, but I'm trying to temper them. So, I guess the difference for me is that I'm a 25-year-old company trying to go to the next round. So I have a history and I have a valuation, but I've also hit a rocky road trying to build in the next level of management. And so I'm trying to figure out, but one of the things that the most, have 100% ownership, one of the scariest things is giving up ownership. because now I'm giving somebody else authority within the decisions. And so I mean, I'm not afraid of 20-25% ownership. What I'm curious about is how you, as you build rounds, as let's say I go after 5 different funders, how do you start to spread that out? Because you can't, 5 funders at 20% is 100% of the company. Now that's just never made sense to me. And how do you learn that?
When I
mean,
say 20%, it would be for that entire angel round. So you might, if you get wealthy individuals, you might get 5 wealthy individuals to each write you 100K. So that's 500K. That 500K total, as that round, would be that 20 to 25%, not each individual investor. So that's one point of
so
clarity.
they don't have 20% ownership in the company, they have 20%.
Of that round. So each individual, I like Mike is,
Each individual has 4%.
Right, I could have 2%, this guy could have 5, he could have 7.
And they
in the
might-
whole
In
totality.
the overtality.
It's
But
20%.
that fundraising event, which would be considered one event with multiple people, and it would be that 20%. So it all adds up to that. But yeah, you have to, and this is also where you have to think about the strategy and the fundamentals. Does it make sense? How's that person gonna get their money back, right? What's the exit? What's the return? Well, in technology companies, you often don't do dividends, through my experience. It's more people waiting for the end event. But if your company is valued at 5 million and they want 10x on that, you have to have a trajectory of like, how are you gonna grow that company 10x? And that impacts the type of investors you seek out. You know, versus someone saying, I'll put in 20,000 and I hopefully in a few years would get 40,000 back. It's a very different type of investor that has a different expectation on how you grow the company. I think this chart I really like to show just the different regions have different ways that they approach valuations and the amount vested. The math still really kind of works at this 20%, but what it impacts is the amount that they're raising. So in the Valley, you might see an angel or seed round, they're raising quite a bit of money versus, you know, in Iowa, kind of that initial seed round is around 500K. So you'll just see people are taking different risks. They have just different approaches to raising money and being thoughtful of where you're raising from and what kind of expectation do they have. If you go to a Silicon Valley company and say you're going to raise 500K, unless they have that in the DNA of their firm to make that small investment, you might not be successful unless you do a larger round because of that audience and because of the way that they invest. If you're trying to raise outside of the 2 coasts, raising $4.5 million on your seed is probably going to be a really hard endeavor because non-coastal areas just don't see that large of rounds and the expectations around those companies. Trevor.
Is this an average or a median or just like 75th quartile? Like what?
I think it was the average of them.
So half of them raise over and half of them raise under?
They all, sorry, you're now asking a mathematical question. Generally, I'll say, I can look at the source and see the exact data. I can't remember.
Okay, so it's like an
It's just
average, you think?
like
It's
average.
just more to point out the difference.
So you did 100, add one and then one massive one and
All right, your stats, not.
I know, I'm like, you're now getting into stats, which I'm not gonna go there. It's more,
yeah,
these are generally the sizes of the rounds,
yeah,
in general.
yeah, got it.
Is that median?
Yeah,
I think it's more the median then. Other questions? All right, the next stage in your handout, Jake, this goes to answer a little bit of your question.
And unfortunately, all of you, the handout is turned sideways, so it's not real.
Okay,
So we are having new ones printed, but we'll hear about some.
okay, we are gonna be bringing new handouts. I think the overview, I'm not gonna go into the details of this, but again, this is generally, if you're in this stage, what are investors typically expecting, seeing in these stages? And I'm gonna say this is a generalization of some of the expectations. There's always someone that's like able to raise with none of these things accomplished, and there's other people that they have all these things accomplished and they have the hardest time raising. So it more serves as a direction of like generally what are the expectations that you can expect when you get from seed, angel, Series A, Series B. Oh, I did have this. Key milestones, use of funds. We talked about this briefly, but this is a representation of how you could use, demonstrate the use of your funds. You're going to raise X, and these are all the things you're going to accomplish. Does anyone have questions on how to demonstrate what you're going to achieve with the funds that you take on? I would say on this one, be careful not to like overpromise and underdeliver. And that's often easy to do when you have no idea how long it's going to take you to accomplish something. But investors remember what you say, so be very thoughtful in what you put out there. Like, with this money, I'm going to accomplish this. Because where it can bite you in the butt, if you're over aggressive in all the things you're going to do, and then 12 months later, you're talking to investors, and they're like, they have whole like analysts that are like in charge of remembering all this information, tracking this information, and they'll pull up your file when you go to meet with them and say, oh, they said they were going to do this, this, and this, and you sit down with them and you haven't done half of that. It's going to raise questions rather than like build the excitement. So probably less is more in this general pitch when you're just getting to know someone. Jacob.
Yeah, can you talk about this point about team growth? And are there, I feel like the people I've spoken with, that there are certain things that they're more interested in funding and certain things are less interested in funding. And is that, I mean, everyone's different, but are there kind of hot spots to think about?
I would say it's somewhat determines on the stage of like what they expect for you to achieve in that stage of company that you're in. I'll just kind of give some high-level thoughts. You know, is your product to the point where you can start to have revenue, right? And do you have to over-invest in your product to kind of get far enough ahead that someone could come along and like create the same thing? So that might be how much you want to invest in product versus, oh my gosh, you spent all this money on product, you haven't shown any sales or any customer traction. I think that's where an investor would call into question how much you're putting into that. Are you scaling up the team, acting like you're a fully functioning business when really you don't need all of those functions yet? That's might be where they call into question, do you need a full-time marketer? Do you need a full-time accountant? Do you need a CFO? Are you scaling up too big of a team and you're not actually ready for that stage yet? Versus, okay, so you just put all this money into this area, but I don't see any sales and marketing budget. How do you expect to like make money? Should you be putting more into that area? Are you over-investing in sales and you yet don't have a product to sell? Like you just need to get out there and do sales even though you might not like it. I mean, those are the things I think an investor strategically thinks through and would push you on.
So it's really about the stage and where you are, what your priorities are, and are your use of funds aligned to support those, or what?
Yes. And I would say from an entrepreneur, you want to think about getting enough traction. The reality is most businesses that go through VC funding will take on multiple stages of funding, multiple rounds. This is like probably is likely not your only round. So what are you going to do to be attractive for the next round? What do you have to achieve? And where do you want to invest the money to like get that next round done? You have to accomplish something that's exciting enough to go raise again.
Perfect timing. So you're talking about earlier how, you know, the last thing you want to do is be, okay, I'm ready to raise my round and not have any relationship with investors. So when you're building those relationships, and it might be 3, 6, 12 months before you're actually interested in raising money, a lot can change in a startup.
Yep.
So do you still need to be wary about, I think we could be in business Q1 2020, and then when you get to the show, you're like Q3 2022?
I think it's a really good point. This is where it's a challenge, right? You need to be out building relationships, but you have to be very careful on what you communicate. And so it's where being very mindful of the entrepreneur of what's coming out of your mouth is important. Because people will remember, but yet they understand. Companies take twists and turns, but being able to then defend the journey that took you on the twists and turns.
Okay.
Does that make sense? Like, and be careful with your storyline. If you, one day you're X product, and the next day you're Y, and the next day we're doing this, and the next day we're doing this, and the next, I think that's kind of a dangerous time to be talking to investors, because you're not able to be succinct in kind of what you're doing, even though like the how and the journey to get there might change. And less is more. If you can boil the conversation up, this is what I'm doing market research, validating my partnerships, and don't say a lot more. It probably will serve you better than having puking of the mouth and saying too much and then not having half that be accomplished.
So think about it as a conversation that you happen. I mean, if you want it to be transactional, you could just be like, look, this is it. I don't want to have a relationship with you other than you believing in my business. And I mean, I'm totally honest. It depends on what you want. But if you want to have that conversation over time to build that trust with the example of like, in 6 or 8 quarters, this is when I'm going to be ready. Yeah, start talking to them now and build that relationship so that when it does come time, they know you, they know that you mean what you say, or there's more of an interest versus just the money.
I think that's a great point. Investors are looking to add value. As much as you're selling them, they're also trying to sell why me, right? So they want to add value along the way. So if there are things that they can help you with, like let them help you, right? Don't be so I got it all together and I'm not going to share some things that I struggle. If there's things that they can help you with, they want to, right? Because if you're such a hot company and you're doing really well, they want you to choose them versus someone else. And that's where the relationship, thank you for making that point, that's where the relationship is really key. It's a two-way street. Okay, we're kind of coming to an end of wrapping up the pitch deck portion. If you have press and user testimonials, these are really, really helpful. If you have a key customer you've been piloting and they can share a testimonial or share something for you to put in your pitch deck, it's really helpful to show validation. Again, anything you put in here, make sure that the person knows that you're including them in the pitch deck, or you don't have some confidentiality around the relationship. All important things. And then plan on getting through the presentation in less than 20 minutes. I've seen decks done really, really well where you can get done in 10 minutes and then you leave the rest of the time to conversation, deep diving, reading the investor, where they're interested, getting time to know them. And if you can kind of pull off the art of it feeling more like a conversation than just a standard pitch, I think that you as the entrepreneur start to feel the magic too when it feels direction, both ways, then you just kind of sitting up there and having no idea where the investors' heads at, thoughts are, what their feedback are. I think this top bullet point, start to do research of like, what are investors benchmarking you against? These are a lot of times where the questions are going to come in. Are there key measurements that they're expecting of your type of business? Are there terminology? You might not even know what MRR, ARR, CAC, LTV, run rate, cash burn are today. And for some businesses, you'll need to know those, and for other businesses, you won't. I'm not going to get into all of these, but if you don't know what those are, I would say spend some time figuring those out, because they might apply to what an investor will ask you around key metrics of your business. I hate to admit, but a couple of those, we moved our business from a consumer-facing business to a SaaS-based company, and I was new within the SaaS-based company framework, and I didn't know that there was kind of standards by which investors judge companies by. It was really embarrassing to kind of learn that the first time, where an investor's like, what's this number, and I was like, I don't know what you're actually saying. Of course, that was not my response. I think I politically said, our numbers are changing. I would rather give you the right data. I'll get back to you at the next 24 hours once I've had a chance to look at that data. I mean, there's ways to recover from that, but You'd rather just be able to give them the data that they're expecting of a business of your type. You know, manufacturing has certain ways that they're judged by. Consumer-based businesses have other kind of metrics that are standard used to judge companies by. You might be wondering, like, how do I figure out what an investor judgment is to me by? Read their blogs. What are they writing about? What are they, typically the things that they're educating you about via their blog are things that they ask entrepreneurs when they sit down with you. Know your customers, be able to give clear use cases, know your competitors. And then there's, in this workbook, there's an example of 30 questions investors are likely to ask entrepreneurs. Read through those. How many of those do you know the answers to? Those are some things that can help prepare you to meet with investors. The other thing is meet with people that might not be your investor, but are willing to ask you really tough questions so that you're kind of learning how to respond, practice a little bit based on someone that's not like number one key investor that you're hoping to get. Like start with some of the other ones first before you kind of sitting down in front of that person you really want to date and get married to. All right.
I would say